Welcome back to Daily Crypto, episode 52.
Yeah, glad to be here.
So today we are jumping straight into, honestly, the single most important development driving the markets right now.
Absolutely.
A surprisingly weak jobs report has just slashed the odds of a Federal Reserve rate hike in half.
Right. Literally cut the odds right down the middle.
And the immediate result, well, Bitcoin just bounced hard off a critical floor of $57,750, and it managed to reclaim the $61,000 level.
Which is a definitive move,
Yeah.
and it proves something fundamental for you, the investor listening right now. Crypto markets are currently trading heavily on traditional macroeconomic indicators.
Right, like liquidity expectations.
Exactly. Rather than just operating purely on their own, internal technological developments, the broader macro environment is, well, it's entirely holding the steering wheel.
Yeah, it really is. And today we are going to explore how this macro shift is impacting everything. I mean, from corporate whales to a massive stablecoin migration that traditional banks are actively predicting.
Oh yeah, that Bank of America warning is huge.
Right. All the way to a highly chaotic regulatory showdown currently unfolding in Washington.
So much to cover.
Yeah, but by the time we wrap up, you will have a clear understanding of the day's biggest takeaways and how all these seemingly isolated events actually fit together.
So to start, the context around Bitcoin's rebound to $61,822, it's essential to grasp. We aren't just looking at an isolated spike in a vacuum here.
No, not at all.
We are looking at a market attempting to recover from a period of severe whiplash. Central banks have been aggressively tightening liquidity.
Which basically means they are pulling available money out of the financial system.
Exactly. And on top of that structural pressure, we've had massive geopolitical shocks.
Yeah, which brings up the $875 million crypto crash we saw recently.
Right, the tariff news.
Yeah, triggered by the news of Donald Trump's proposed Europe tariffs.
Yeah.
I mean, nearly $1 billion in value was just wiped out because of geopolitical trade tensions.
It was brutal.
The market was under immense pressure. But then we get this weak jobs report. So walk us through the mechanics of that. Like, how does a piece of traditional labor data literally translate to Bitcoin going up?
Well, it acts as a pressure release valve for the financial plumbing. When job growth slows down, traditional markets assume the Federal Reserve will just back off on raising interest rates.
Just to avoid stalling the broader economy.
Precisely. Because higher interest rates make borrowing expensive, and that pulls capital away from risk-on assets.
Things like tech stocks and, of course, Bitcoin.
Yeah, exactly. So when the odds of a rate hike suddenly get slashed in half by that weak jobs data, the market just breathes this massive sigh of relief. The cost of capital isn't going to get as painfully high as expected.
So we saw immediate seller exhaustion.
Right. The automated algorithms and the traders who were just relentlessly dumping their assets, they just stopped.
Interesting. And, in a minute, we'll see why a traditional banking giant is suddenly sounding the alarm about $6 trillion moving on-chain because of this.
Yeah, that's a massive shift.
But this macro floor is crucial. But it's only surviving because of massive institutional cash, right? But before we look at that $6 trillion shift, I need to challenge this narrative about Bitcoin's resilience.
Okay, let's hear it.
Because looking at this price action, the crypto market feels less like an independent asset class and more like a hypersensitive seismograph.
That's a good way to put it.
Right. It's aggressively reacting to every traditional macro tremor. So logically, is this jobs report bounce actually a true trend reversal? Or is it just a temporary relief rally that's masking deeper liquidity issues?
I mean, it is a bit of both, honestly, which is exactly where the risk and the opportunity lie for anyone analyzing this space. It is a relief rally because the fundamental tightening of central bank liquidity hasn't permanently reversed.
It has just paused.
Exactly, it paused. So the risk is that macro volatility can still wipe out billions of dollars in hours if, say, next month's inflation or jobs data points the other way.
So the threat is still very real for investors.
Oh, absolutely. But the opportunity is that the market just identified a very hard floor. The market violently rejected prices below $57,750.
Right. It bounced hard there.
Yeah, and that tells us that deep-pocketed buyers see immense calculated value at that specific price point. Investor sentiment is shifting rapidly based on rate hike probabilities, but the foundation itself is proving remarkably resilient.
Okay, so the macro data sets that baseline floor, but central bank liquidity is just the ocean, right?
Right.
The corporate whales are the ones actually making waves right now, and the scale of their moves is staggering. Let's look at the divergence in corporate strategies, starting with MicroStrategy.
Yeah, this is fascinating.
They've just filed to sell $1.25 billion in Bitcoin. On the surface, that sounds like a bearish dump, doesn't it?
It does. But Grayscale's research suggests something else entirely. They think MicroStrategy might be sitting on a $1.5 billion cash flow problem.
Oh, wow. So this might be an operational necessity to just keep the lights on.
Exactly.
Yeah.
Rather than a loss of faith in Bitcoin itself. Selling to cover operational overhead is entirely different from selling because you believe the asset is going to zero.
Yeah, that's a massive distinction.
Right. And you can see that continued faith playing out elsewhere. Look at Japan's Metaplanet. They just announced a $137 million capital raise, specifically to build out their Bitcoin balance sheet.
And they are doing that through a third-party allotment, which I find to be an interesting mechanic.
It's very targeted.
Yeah, like instead of selling shares to the public on the open market, they are bypassing that completely and selling directly to a select group of heavy-hitting private investors to get cash fast.
Precisely. It shows an aggressive accumulation strategy. So you have one massive corporate whale potentially forced to sell for cash flow, while another is utilizing specialized financial tools to raise 9 figures just to buy more.
It just illustrates that institutional accumulation is a really complex, multi-layered ecosystem.
Yeah, it's not a monolith at all.
But the true institutional shift, like the one that could fundamentally rewrite global finance, it isn't just happening with Bitcoin.
No, it's stablecoins.
Exactly. Traditional finance is suddenly diving in headfirst. Barclays just made its first ever stablecoin investment, taking a stake in a company called Ubix.
Which is a big signal.
But the real shocker came from Bank of America. Their CEO warned that $6 trillion in deposits could flow out of traditional bank accounts and into stablecoins.
Yeah, and coming up, we'll reveal the single piece of legislation that could make or break this institutional adoption before the August recess, because it's heavily tied to this.
Right, because to put that figure into perspective, $6 trillion, I mean, the entire market cap of all cryptocurrencies combined right now is just a fraction of that.
It's massive.
Right.
And the mechanics of this threat are existential for banks. I mean, traditional banks rely on your deposits to make loans and generate their own yield.
Right.
They might pay you 1% interest, but they're lending your money out at 7% and just keeping the difference.
Yeah, that's literally their entire business model.
Exactly. But if users realize they can hold digitized blockchain-based dollars, stablecoins, and capture a much higher yield themselves without the bank acting as a middleman extracting fees, the traditional plumbing breaks.
So it's like consumers suddenly figuring out how to buy electricity directly from the power plant for pennies,
Right.
just entirely bypassing the local utility company's massive markup. Like Blockbuster nervously watching Netflix get popular.
That is the perfect analogy. The banks are the utility company, and they're realizing the grid is fundamentally changing.
So are stablecoins essentially the financial system's fiber optic cable upgrade? I mean, it looks like the old system because it's still pegged to the dollar, but the underlying infrastructure is just entirely different.
That is exactly what it is. Stablecoins lack the volatility of Bitcoin, which makes them palatable to corporate treasuries and everyday consumers. The market impact of these traditional finance investments, like Barclays, is a massive legitimization of the technology.
But there is a severe risk here too, right?
Huge risk. When billions, let alone trillions of dollars start moving outside traditional banking rails, the regulatory magnifying glass gets incredibly hot.
We saw this recently, didn't we? When filings revealed that Donald Trump earned $1.4 billion in crypto last year.
Yeah, and almost immediately his new stablecoin venture came under intense scrutiny.
Right. Because traditional banks aren't just going to quietly watch $6 trillion in deposits walk out the door to stablecoins. They are going to call their lobbyists.
Of course they are.
Which explains why the regulatory environment in Washington has suddenly turned into a complete battlefield. You simply cannot have a $6 trillion stablecoin migration without a legal framework.
You can't. The technology is ready, the capital is clearly ready, but the rules of the road are completely unpaved right now.
So let's examine this Washington showdown, because the focal point right now is the Clarity Act. This is the big legislative push.
Yeah, it's the centerpiece.
Currently, though, it is facing sub 50% odds of actually passing the Senate. But the first major law enforcement group just officially endorsed the Clarity Act.
Which was unexpected by a lot of people.
Very. And according to SEC Commissioner Hester Pierce, that endorsement could be the exact catalyst needed to flip the Senate vote before the August recess.
Well, you have to look at the mechanics of political capital here. For years, the easiest narrative for politicians has been that crypto is strictly for illicit finance, right?
Yeah, the classic boogeyman argument.
Exactly. So having a major law enforcement body step up and say, actually, this specific legislation gives us the oversight tools we need, well, that completely disarms the biggest political argument against the asset class.
It provides cover for politicians to vote yes without looking soft on crime.
Spot on. And if the Clarity Act passes, it provides the legal certainty needed to open the floodgates for that $6 trillion Bank of America is so worried about.
But the environment around this bill is total chaos right now. I mean, Coinbase is actively threatening to pull their backing for a Senate crypto bill entirely because of how the negotiations are being handled.
It's getting very messy.
And simultaneously, you have U.S. senators slamming the Department of Justice over shutting down its crypto crime unit. The unit was apparently shut down amid conflict of interest questions regarding personal holdings, specifically pointing to Kash Patel.
Yeah, that made a lot of headlines.
And just to be entirely clear for you listening, our job here is to impartially report the facts from the sources provided. We are not endorsing any political viewpoints, nor are we taking sides regarding the DOJ, Donald Trump, or the U.S. senators involved.
Right, we're just analyzing the impacts.
Exactly. We are simply laying out the facts of the regulatory environment as they exist in the reporting.
And looking analytically at those reported facts, the risk profile for investors is incredibly high right now. Investment banks are warning that if the Clarity Act doesn't pass before this August recess, the impending 2026 elections could stall major U.S. crypto legislation entirely.
Oh, because politicians despise taking votes on complex, controversial financial regulations right before an election cycle.
Exactly. If it stalls now, we're looking at years of continued regulatory limbo.
It's like trying to referee a soccer match, where half the officials are blowing whistles for offsides and the other half are actively trying to confiscate the ball.
Yeah, that's exactly what it feels like.
You have one agency shutting down a crypto crime unit over personal conflicts, another pushing new laws, law enforcement endorsing bills, and major exchanges threatening to pull out. How is institutional money supposed to confidently enter the space when the rulebook is in this state of flux?
I mean, it is the defining friction point for the entire asset class. Institutional money craves predictability above all else.
Right.
They can build financial models for high taxes, they can build models for strict compliance, but they cannot model for retroactive enforcement and constantly changing definitions.
That makes sense.
That's why the Clarity Act's fate is so pivotal. Establishing that a stable rulebook simply exists is almost more important than what the specific rules actually are at this point.
Yeah, and stay with us because we're about to look at how two major altcoins are completely ignoring this regulatory drama and violently squeezing short sellers.
Yeah, the network activity is completely disconnected from the Washington noise.
Exactly. While Washington debates these rules, the actual networks are just putting their heads down and building. Let's look at XRP and Cardano's ADA. XRP is currently trading at $1.11, pushing aggressively above key resistance levels.
Yeah, it's showing massive strength.
And it did this while completely brushing off a 1 billion token unlock.
Which is wild. Because to understand why the market ignoring that is so significant, we have to look at the mechanics of token dilution. Usually, when a billion tokens are suddenly released into the circulating supply from escrow, basic supply and demand dictates that the price should drop.
Right, because there is simply more of the asset available to buy.
Exactly. But XRP absorbed that massive influx of supply without even blinking. The institutional tailwinds are entirely overpowering the dilution effect.
Because there is massive foundational technology rolling out. The XRP ledger lending amendments are currently facing an 80% validator hurdle. And if that passes, it creates a true native institutional credit layer right on the XRP ledger. And we need to explain what that actually means for people. It's not just a simple transfer of value.
No, it's much deeper.
It's embedding the complex logic of collateralized lending like a fully automated programmatic mortgage broker directly into the blockchain code itself.
Exactly. And alongside that, you have Ripple's CTO proposing a new feature called reserve trixons. This is designed to mathematically block front-running on their decentralized exchange.
Now, front-running is a huge problem. For those unfamiliar, front-running on a decentralized exchange is basically someone seeing your order to buy an asset while it's sitting in the public waiting area.
The mempool, yeah.
Right, the mempool. So a bot sees your order, pays a slightly higher processing fee to jump the line, buys the asset before you do, and then immediately sells it to you at a higher price. It's algorithmic theft. So how does Reserve TRXNs actually stop that?
By altering the execution mechanics entirely. Instead of transactions being processed purely based on who pays the highest gas fee to jump a line, Reserve 2xn allows a user to claim a specific block space in advance.
Oh, wow. So you just reserve your spot.
Exactly.
Yeah.
It fundamentally breaks the ability of trading bots to reorder transactions for their own profit. When you combine that technical fix with the 80% validator hurdle, which proves the network is highly decentralized and requires overwhelming consensus to upgrade, you start to see why the market is so bullish.
Plus, there's the geopolitical angle, right? Escalating disputes between the U.S. and Iran are forcing international players to look for neutral, global payment rails that aren't controlled by a single government.
Yeah, and XRP is positioning itself perfectly for that narrative. It's the alignment of technological upgrades with a profound geopolitical need.
Right.
If XRP successfully implements this institutional credit layer and solves the front-running issue, it transforms from just a cross-border payment token into a fully-fledged institutional decentralized finance hub.
That is exactly why investors just ate up that 1 billion token unlock. They aren't pricing the current supply, they're pricing the future utility.
Exactly.
And then there is Cardano, ADA. ADA shorts just got absolutely squeezed to the tune of $857,000 in liquidations in a single 24-hour period.
Ouch.
Yeah, if you were betting against ADA dropping, you just got wiped out. Meanwhile, the number of ADA whale wallets just hit an all-time high. But here is the critical data point, the part that is so confusing.
Yeah, the hack.
They are accumulating despite the fact that the ecosystem just suffered an $18.5 million hack. And this is total mystery. Even the company that built the wallet cannot explain how the exploit happened.
It is one of the most fascinating paradoxes in decentralized systems.
I mean, ADA is acting like a battleship that just took a torpedo to the hull, but the crew, the whales, are completely ignoring the alarm bells and actively buying more ammunition.
Yeah, it's wild.
I have to challenge this logic. Isn't an $18.5 million mystery hack a massive glaring red flag for anyone trying to build the kind of institutional credit layers we were just talking about? If the engineers don't even know how the money was stolen, how can investors confidently squeeze short sellers?
Well, it highlights a very specific dichotomy in how crypto whales evaluate risk. In traditional finance, if an $18 million vault is emptied and the bank engineers don't know how, deposits freeze instantly. The entire institution is compromised.
Right, total panic.
But in crypto, you have to separate the application layer from the base layer. If the core layer 1 protocol of Cardano remains secure, meaning the underlying blockchain consensus wasn't broken, just a specific third-party wallet interface built on top of it. Whales often view these events as isolated stress tests.
Oh, I see. So they view the underlying network as sound, even if the app built on it was flawed.
Exactly. They see the subsequent price dip caused by retail panic as a discount. They are betting on the long-term resilience of the base layer. They squeeze the short sellers because the shorts assume the hack indicates a systemic failure of the whole chain.
Ah, right.
The whales, understanding the technical difference between a wallet exploit and a blockchain failure, they simply step in and buy the fear.
That makes a lot of sense. So what does this all mean for you, the listener, navigating this landscape today? We've covered the mechanics of a lot of moving parts, from macroeconomic shifts down to front-running algorithms.
Yeah, let's tie it all together.
Let's distill this into the 3 most important insights you need to take away from today's sources. First, macroeconomic data. Specifically, liquidity indicators like today's weak jobs report is currently the primary force establishing the hard floor for Bitcoin's price.
Yes, the market is trading on traditional liquidity signals, plain and simple.
Second, traditional finance isn't just watching from the sidelines. With Barclays investing in infrastructure and Bank of America warning of a $6 trillion deposit flight, traditional banks are actively preparing for a massive structural shift into stablecoins.
Absolutely. The underlying plumbing of global finance is being rewired for yield efficiency in real time.
And third, regulatory clarity remains the ultimate wildcard. The technological infrastructure is rapidly advancing, solving complex problems like front-running, as we saw with XRP.
Right.
But the fate of widespread institutional adoption rests heavily on the looming Senate vote for the Clarity Act. and whether it can survive the chaotic partisan environment in Washington before the August recess.
Watching how these three pillars, macro data, traditional finance adoption, and regulation interact over the next few weeks, well, that will dictate the market trend for the rest of the year.
Thanks for listening to Daily Crypto.
Crypto market thought of the day.
In a market that reacts like a hypersensitive seismograph to every macro tremor, patience and strict risk management are your greatest assets. The daily noise and mystery hacks will try to shake you out of your positions, but structural shifts like the rise of decentralized credit layers take time to properly materialize. So, I'll leave you with this to ponder. What exactly happens to global financial stability when the $6 trillion stablecoin shift warned about by Bank of America collides head-on with a completely unresolved regulatory environment in Washington?